Two trades, same setup, same rules, same model. One hits a full stop loss, the other goes for a +3R win. So what changed? Nothing, except time. Let me show you why that matters. My name is Vi. I review my real back tests using market structure, liquidity, and supply and demand as I work towards consistent profitability. If you're serious about building real skills instead of chasing signals, then you're in the right place. This is for educational purposes only and not financial advice. Let's break it down. So for the first trade we're going to review, we start on the 15-minute chart. Our order flow is presently bullish. We have a swing high and a swing low. Price has just liquidated what we believe is the strong low in the price leg. That's important. Liquidity has been taken, and in theory, buyers should now step in. At this point, we drop down to the 1 minute. Here on the 1 minute, we identify the pullback where sellers were previously in control. For me, that's right here, given the displacement we see, as well as the aggressive move down as represented by the candles. If buyers can close above this level, that signals a shift in order flow. And at around 11:30, we see exactly that, as we see a bullish candle close above our key level represented by the blue line. It's a strong close above structure, and that means order flow has shifted. We look for longs in alignment with the 15-minute order flow. We enter on a 1-minute fair value gap and set our stops above the most recent lows. And as we move up to the 5-minute chart, we can see that almost immediately we're stopped out. Full loss, no chance to take any partial profits. The structure fails, and the 15-minute order flow is now bearish. This trade is over, and this is the first result. Back on the 15-minute chart, I've advanced us forward a few days. You can see the original trade we took here, as well as the new swing low that was created, which turned the order flow bearish. We can see that in the 3 days that passed, structure shifted multiple times until we reach our point here today. As we zoom in on our current day activity, notice that we're again bullish on the 15-minute order flow, with a swing high here and a swing low down there. As we move the clock forward, price once again liquidates a presumed strong low. Sound familiar? It's the same narrative, same logic, same model. For an entry position, we drop down to the 1-minute chart to see if a reversal in order flow has been confirmed. Again, we can see that sellers have pushed price down and created an internal break to the downside here. If buyers can reclaim this level denoted by the blue line, then we can assume a reversal in order flow and look for an entry long. And once again, buyers close above the key level we identified. Our reversal shift has been confirmed. We place our entry at a 1-minute fair value gap, stops below our low, just like the first trade, and eventually target this collection of orders here, assuming price wants to rebalance and find this price zone again. This time, price spends a little time in drawdown, but then starts to explode upwards, and in no time full take profits hit. This results in a 3.5R trade win. Same model, completely different outcome. For me, here's the real takeaway. The model didn't fail the first time. It simply didn't work that day. Losses are not proof your strategy is broken. They are simply the cost of doing business. If I had abandoned the model after the first trade, I never would have taken the second one, and I would have missed out on a 3.5R winner. I'm learning that the edge only plays out over a long series of trades, not just one. Mental fortitude is part of the system, and that's what I'm working to build right now. If this breakdown helped you understand the importance of consistency and execution over emotion, then subscribe. And check into this backtesting video where I break down another trade using this exact model. Let's keep sharpening our edge together, and I'll see you in the next video.